Hey yo, what is up? This is Dudediligence here, and today we're gonna talk about warranties. And once again, thank you so much for my Patreon members and all of you who are supporting me on either on YouTube or on Twitter. And without my Patreon members' contribution, I probably won't be able to do a lot of things I do, and especially the future challenges that we're gonna do. And for those of you who want to see what we do on Patreon, you're more than welcome to join. It's $10 per month, and we do a lot of interesting stuff on Patreon. And per my Patreon members' request right here, we're going to talk about warranties, what's the difference between options and warranties, and some of the very market-specific stuff about DWAC's warranty. Okay? Let's get into it. So this is about warranties. Seems like all of you like the very specific and scripted approach, and here we go. And this is gonna be a notepad that we open up, and we're gonna just talk through all these points. And also it's for those of you who just wanna know what's on there, take a screenshot of that, and then you can come back and review it later on, and we're just gonna start, okay? So basically, warranties are like options, but they're not really like options in its own way. In terms of how market mechanics goes, warranties basically is a right to buy, but not an obligation to buy or sell. And usually company issues call warranties than put warranties. For those of you who don't know what call warranty is and put warranties, basically it's similar as call options and put options. Call warranties is basically rights to purchase at a certain strike price, and put warranty is rights to sell at a certain strike price. Okay, warranties are usually cheaper due to its innate capital structure effect. Okay, we're gonna go on that point a little bit, why there's a innate capital effect. Basically, on every warranty that you buy in, the company has to issue more stock, therefore it's kind of dilutive in its own way. And then the fact that warranties are a long-term sort of instrument, we will cover that. Okay, and then B, options are short, medium-term instrument, usually about 3 years top. If you go and look at every option chain, you'll realize that most option chains are priced 3 years ahead, and the price adjustment of longer-term options will be more drastic than the price adjustment of short-term options. But when market moves, the short-term options volatility will exceed the volatility of long-term options, depending on what percentage of movement that the option is. Okay. And versus warranties. Warranties, some of them last about 15 years. That's a heck of a long time, right? And most warranties last about 5 years. And for those of you who, the reason why you guys probably are interested in warranty is because you don't really actively trade them, but because you hold SPAC shares pre-merger or pre-closing, whatever you call that, or de-SPAC day, right? You guys are entitled to warranties that give you sort of like a strike. Most likely it's $11.5 to buy one share for every share you own, but different companies have different rules of redemption rules and commencing rules. We're going to get into that. And usually most of them last about 5 years. Some of them last about 3 years, but it's usually more than 3 years. Okay, warranties are company issued. So here is the more sort of like the fundamental difference in terms of how cap structure will work out with warranties versus options. Warranties are like company issues, right? It's like a company specific rights that they issue warranties to investors, and then you buy it, and then you sort of raise capital directly towards the company. Okay, so whatever you so for example, right, we're going to talk about like a specific example later on. So if you just want a rundown, basically if you buy one warranty at $11.5 per share, like you exercise the warranty, that means you basically paid $11.5 for one shares of I don't know, like whatever stock that the warranty is giving you the rights to buy. And then that $11.5 goes directly into the company's balance sheet, so on book, because you have to do cash, you have to actually pay cash to get it because you're exercising it. You see, and because you have to pay cash for it, therefore warranty strike price is actually what warranties trading a warranty, like the base value of the warranty the traded on exchanges are usually way lower than options, because you actually have to give up the cash to exercise it. and sometimes, due to like a lot of fees involved in redemption, you actually don't really make that much of a profit unless the price of the stock is huge, right? Like DWAC, right? DWAC is DWAC. We're going to talk about that later on. Okay. Options are investor transaction. What does that mean? A lot of you don't know is all of these stocks traded on the exchanges, the company itself actually does not really benefit from stock appreciation, like the stock price appreciation, unless they own a restricted stock unit, they have preserved stock unit, or they purchase their own stock for later use or whatever, right? That they will benefit from appreciation that way. So technically, company itself does not benefit from stock exchange movement of price appreciation, okay? And then options are non-dilutive on paper, but whenever I say it's non-dilutive, there's always like, someone jumping out, or one of my mentors would jump out and be like, oh my god, you're so wrong on this video, because the true value of this is this and this and that, therefore they actually have a dilutive effect. And for those of you who don't know, I have mentors who trade options, trade futures for seasoned VCs, and I just got a new one actually today. We had a almost 2 hour conversation on meme stocks in the market, and he's a long short equity guy, so he basically runs his own hedge fund. Anyways, just for them who's gonna watch it, but which accounted for 5 or 6 viewership at this point. But special cases might apply. So if splits, reverse splits, or other things happen, or funder vesting cases happening, and you have a lot of like real value calculation happening, it might become dilutive in reality, but it's not dilutive on paper, okay? And warrants time value is calculated different than options. So as we all know, then when you have a period of high volatility in the stock market, the short-term options will go up the most percentage-wise, right? Because in case of due to theta decay and all of the time value decaying factors, the calculation goes into that and will give you extra leverage. But in warranties case, because it's like a less complicated version of options, because the intent of the warranty is very different than an option. Usually in the intent of a warranty, in EU, usually people issue bonds with a warranty pegged to the bonds to offset immediate interest revenue on valuations. So then the bond will actually trade on the market in a very smooth curve, right? We typically call them the yield curve. The yield curve will be smoother than before, and also the time value of warranty were calculated based on like maximum efficiency on expiry. So it's on like a 5-year basis, some on a 15-year basis. So you actually don't really see that much of volatility unless the price of the underlying stock actually went up dramatically. But due to the dilutive factor of warranties, on a 100% increase in a stock might not have a 100% increase in warranty prices. Actually, we're going to get into that, because the complication of the exercising warranty is a little bit different from exercising options, because options are still liquid on the market, but warranty is not. Okay, so some examples, right? We can use DNA as an example. Jingo Biotics, whatever you call that. SPAC pipe at 10. Actually, this one, you know what? DNA is actually a really complicated examples here, because at one point their the pipe value actually go down to 8.92. So the real value of the pipe is actually way less than that. If you guys want me to make a video on DNA's pipe and DNA's warranties, and when we talk about the underlying factors of the real value of DNA, which is not actually at pipe at 10. For those of you who think a lot of SPACs, they have a SPAC floor, but the thing is, SPAC floor actually adjusted based on their terms on the term sheet. You can find terms on 424B3 and a lot of other things. They have commencing agreements and all this kind of stuff. As you know, the financial market is actually quite complex if you go to those term sheets. So a simple or easy example is just DD specs, right? Let's just say we're gonna do a spec. Let's just say the pipe is at $10 and it always stays at 10. There's no volatile movement. It stays at 10 forever because DD has really great credibility as a spec investor and a spec, I don't know, LP. And then the actual base for acquired firms is actually $8 because for spec founders, there's 20% implied free margin for them. For those of you who, do I have to explain this? You know what, I'm trying to make this video short, so if you guys want a in-depth spec tutorial, spec valuation tutorial, I can make one. If you like this video, comment down below, subscribe or whatever, right? If there's enough people who ask for it, or if, you know, you can just tell one of my Patreon members and just start like, oh my god, Didi, please make that video. You know what, by the end of this month, I probably will have more time to make those detailed tutorial videos on financial instruments. We can also make other instruments, like, you know, you guys want to know about derivatives, you guys want to know about the underlying price of a OTC pink sheet stock, blah 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 blah, all this kind of stuff, right? For every shares that you hold pre-SPAC transactions, aka closing of the SPAC deal, okay, you have, let's just say, warrants that will grant you the rights to buy our SPAC, the DD SPAC, at $11.5 per share for every, let's just say, one share of DD SPAC that you own. And then this warranty expires 5 years after closing, okay? Then the actual warranty premium at SPAC closing is $1.5. You pay $1.5 premium, okay? How do you calculate that? 11.5 minus $10, okay? And if warrants are exercised, the company, which is my company, DD's company, will issue X amount of exercised shares, so warranties are basically dilutive. So what does that mean is, let's just say you own 1,000 shares of DD at $10 pre-SPAC, and then after SPAC, because we're doing a 1-to-1 warranty conversion rate, you can buy up to 1,000 shares of the DD after the merger closes at $11.5, okay? And then when you decided to buy 1,000 shares, I mean, DD have to issue another 1,000 shares into the market. So basically, if you're really trying to calculate the real effect of your warranty on the market, you have to calculate the dilutive factor of warranty on the actual stock price, which we're going to get into, not this video probably, because it's going to be too long and there's too many maths involved. The pricing of the warranty usually lags due to the time value realization and the commencing term of warranty. So if we look at let's just use DNA as an example. So if you go search commence, oh my god, you can see that the commencing terms are a little bit different. So you have all of this. Well, these are intellectual property stuff. Let's see. We have commencing rights. So if you search warrant, you'll see all of these things, okay? And then in here, you go to consideration to holders. You have all of these commencing statements. And then if you're really doing a very in-depth analysis on the actual pricing model of the warrants, and then whether buying into warrants or trade warrant is viable, you have to actually use probability distribution for all 4 of these situations, and you will calculate an expected value of warranty gains or warranty losses or warranty base pricing. And then later on, based on price movement, you will do another calculation, which we'll probably not cover here because it's really late and I want to make this video short. Anyways, where are we? So its original price is $11.5 per share, right? Okay, let's wait, sorry. So let's just use DWAC, right, the Trump SPAC as an example, right? Because since my Patreon member specifically asked for it. Its original price is $11.5 per share. Hence, every share you redeem as a warranty exercisation, the company, we basically help the company raise $11.5 per share from the activity of you exercising that warranty, okay? And the Trump SPAC is a little bit interesting because the SPAC, if you go like the SPAC redemption rule or whatever you call that, redemption rule, exercising rule, every one share you hold, you are entitled to basically one warranty to buy. So basically you can buy one share for every 2 shares you own pre-SPAC. pre-SPAC, okay? So let's say you own 100 shares per pre-close on DWAC, right? You can buy 50 shares of DWAC at 11.5 30 days after the closing of the SPAC deal, okay? And then this 30 days sort of like a deal clause or period of lockup for you is subject to commencing terms. We talk about commencing terms for DNA, and we probably don't want to talk about commencing terms for DWAC because I think the DWAC is really straightforward. It has the generalization. It has a very general redemption rule, which is a 30-day redemption rule, and we don't really need to talk about specific commencing rules here because we don't really want to price it in this video. And let's just say DWAC go nuts. Okay, it actually went nuts, right? So up to $60 or whatever, and then warranty will go up too. However, the magnitude of the upside of the warranty will be less leveraged than an option contract. Why is that? Because in order to exercise a warrant, you have to pay the $11.5 per share. That means if you want to exercise 100 shares of your warranty, you have to have at least $1,150 in hand to basically do that exercise, and you have to wait a period of time for the exercise to go through, and then you will get the base cost, whatever base cost you get. In this case, it's technically $10 of base cost, and then your implied gain will be $60 in this case because we're saying DWAC went nuts and went up to 60. So your implied gain is actually 60 minus $11.5. But on paper, your implied gain is actually 60 minus $10 because $1.5 is a premium you pay to obtain that exercise, to obtain the right to exercise in that warranty. Does that make sense? Hopefully it does. So let's check if DWAC is traded at, let's just say, market value. Let's look at DWAC's market value, okay? DWAC stock. So if you look at DWAC stock, it's traded at $70 or something like that. And let's just say it stabilizes around $60. So the actual price base for DWAC, it's probably like $60 when you consider warranties, but depending on how long it's gonna stay at over $60. So let's what was the plan? Let's do some eyeball calculation for DWAC W, which is the warranty. So you have, let's just $60. It's 6x the original price. So let's just do some calculations in my head. The warranty started at $11.5. Therefore, it's probably going to trade at around like $22 to about $30-ish because of the implied time value and the implied conversion factor. So let's look at DWAC W. Oh, there you go. DWAC W. Oh, there you go. Damn, I actually searched for this before, like a month ago or whatever. I guess I was looking into warranty beforehand. I was actually trying to look into the implied margin of a warranty, especially when when the stock market is going down. But the thing is, shorting a warranty is actually really hard. We're not gonna like really get into that because warranty have a base price, and whenever there's a base price, you're trying to short those kind of stuff. It's kind of awkward and weird. And then anyways, we're gonna get into that if you guys are interested in that kind of stuff. So I said it's about $22 to $30, so it's at 24. Both the bull market is somewhere where it's at, right? And then usually it won't reach 30 because long-term investors won't think that it will stabilize at $60. So yeah, this is it for this video. Hopefully it's very helpful. You probably have follow-up questions. I think the Patreon member who asked for this is Martin for this content. If you have question asking in Patreon chat, I'll make a follow-up video or just comment down below in YouTube or something like that. In YouTube, I don't really want to make everything like way too long or too complicated. So if you want me to show you the very complex, not really complex, it's basically just subtraction at this point, right? And give it a discount, those kind of stuff. I'll show you in Patreon. And then if you think that I should post it out, because you gave me the video idea, I will make a more detailed video on how to do that in a video and then post it on YouTube or whatever if you really want me to. And this is it for the video. If you like those kind of videos, smash a like button and subscribe. See you guys on the upside. Hope you guys love the educational content. Okay?